Warren Buffett once said the right time to sell a company is never. That idea is the North Star for a rule number one investor. The perfect investment is a business so wonderful and so well bought that you never have to sell it. Think of that as the ideal mindset. Buy like you own the whole business. Buy with the intention of holding forever, and let compounding do the heavy lifting. Now, that is a mindset, not a law. Companies change. Management changes. Industries change. Even Warren Buffett has sold businesses. So while we aim to never sell, rule number one also gives us clear reasons and rules for when to sell. The chapter walks through why holding forever is so powerful, what forces can destroy a once wonderful business, and the 2 times you should actually sell. First, why holding forever is such a huge advantage. A business compounds your money for you. If you own a company that keeps returning, say, 15% a year, and you leave the profits inside the business, you do not have to find another place to reinvest your gains. That consistent reinvestment is the secret sauce that makes small amounts grow into fortunes. Phil Town gives examples, companies that grew at roughly 25% a year for 20 years, and how $10,000 invested in the right business could become a very large nest egg over time. He then gives a realistic example. Imagine buying a company for $10 a share that reliably grows its earnings for many years. If you never sell, and the business compounds at high rates, that $10 can turn into a huge amount over decades. You might split the stock along the way. So instead of one share at $1,000, you might have many shares that, in total, equal that same big value. The point is that compounding inside a great business beats moving money around. Still, we have to know when to sell. Phil gives 2 clear reasons to sell. Number 1, sell when the business has ceased to be wonderful. Remember the 4 M's? Meaning, moat, management, and margin of safety. A business stops being wonderful when its moat has been breached by an outside attack, or when the insiders, the management, stop acting like owners. An outside attack is a competitor or innovation that makes the business obsolete or strips away its competitive advantage. Think of how new technologies killed typewriters and videotape stores. An inside trader is a leader who chases empire building, spends cash poorly, or chooses growth at the wrong return on investment, thereby destroying owner value. Both problems show up in the big 5 numbers. When those numbers deteriorate, get out. Number 2, sell when the market price is above the sticker price. The sticker price is your sensible estimate of what the business is worth today, based on conservative projections. If the market has driven the price above that sensible number, you can sell and look for a better opportunity. That is not a defeat, it is discipline. Phil uses Apollo Group as an illustration. If Apollo grew strongly, and the market later prices it above the calculated sticker price, selling makes sense. You realize gains, and then watch the company on your watch list.